Hi, everyone. This is Emily Platt from the Wealthspire Investment Team, and welcome back to Markets in 2 Minutes for the month of November. Today, we're delving into the U.S. government's debt refinancing efforts and the potential impact on interest rates. At the start of each quarter, the Treasury announces the expected volume of debt issuance and its composition among bills, notes, and bonds. The recent quarterly refunding announcement, or QRA, revealed two critical aspects: a slightly smaller size than anticipated, and a shift towards issuing more short duration T-bills over longer duration notes and bonds. The strategic adjustment suggests an approach to mitigate interest rate sensitivity, influencing both fixed income and equity markets. Given the expectation that perhaps the Treasury Department is not going to need to borrow as much as anticipated, there was a 0.5% drop in the 10-year Treasury rate in the span of a couple days, which doesn't happen all that frequently. The Federal Reserve's recent actions, including increasing the Fed funds rate, directly influences yields on Treasury bills and other short-term securities. This rise in rates impacts government borrowing costs and shapes investor behavior. Households and institutional buyers like banks and pension plans showed renewed interest in treasuries, especially with yields around 5% for an investment with limited credit risk. As one anecdotal piece of evidence, there was a surge in individuals opening accounts on Treasury Direct in 2022, indicating a growing preference for purchasing government debt. The pivotal question for investors is the relative attractiveness of these securities compared to other investment options with similar returns and risks. Additionally, the landscape of foreign and Federal Reserve involvement in U.S. Treasury markets is evolving. Japan, a key foreign investor, has increased its holdings in U.S. Treasuries for a third straight month, reaffirming its significant role, where in contrast, China's holdings decreased to their lowest since May of 2009. Overall, the foreign share of U.S. debt declined from 49% in 2011 to 30% by the end of 2022, partially due to increased purchases by the Fed during the COVID-19 pandemic. As the Fed shifts its strategy, reducing its balance sheet to address inflation by allowing debt to mature without reinvestment, the role of domestic and other international investors gains prominence. This change signals a need for vigilance regarding the evolving dynamics of Treasury purchases, with a focus on future involvement of both traditional and new investors. As we've seen, the U.S. Treasury's approach to debt refinancing, influenced by the composition and size of debt issues, has implications for interest rates and market dynamics. The trend towards higher yields is attracting diverse investors, while shifts in the roles of the Federal Reserve and foreign buyers are reshaping the Treasury market. The key takeaway here is the evolving landscape of U.S. government bonds, highlighting the need for investors to stay informed and adaptive to the changing financial environment. With that, thank you for joining us for this month's Markets in 2 Minutes.